Usually when we look for incredible profit margins or sweeping earnings beats, we immediately turn our eyes to Silicon Valley.
Oh, yeah, absolutely.
Right. We think about software as a service or scalable algorithms, cloud computing. But what if I told you that one of the most fascinating growth engines in the entire economy right now is dealing with literal garbage, toxic sludge, and, used motor oil?
I mean, it definitely forces a complete rethink of what high-tech margin expansion actually looks like out in the real world. You start realizing that the physical economy has its own version of viral growth.
It really does. So today we're doing a deep dive into the Q1 2026 financials from Clean Harbors.
Ticker symbol CLH.
Exactly, CLH. We've pulled together their latest earnings call transcript, their press release, and their investor presentation to really figure out how this highly unglamorous dirty jobs company is quietly leveraging geopolitics, environmental regulations, and a very aggressive pricing strategy to just generate these record-breaking profits.
Yeah, and if you look at the data, it's pretty wild. They have expanded their margins for 16 consecutive quarters.
16?
Yeah, that is 4 solid years of getting more and more profitable, literally quarter after quarter.
It's relentless.
Setting the analytical stage here, for you listening, this is essentially a story about the hidden machinery of modern life. While the broader market might be completely fixated on flashy tech stocks or, the latest virtual reality headset, the actual backbone of the economy is found in companies like this.
Yeah, the ones doing the dirty work.
Precisely. They are the ones handling the messy, highly regulated realities of industrial production so everything else can just keep functioning.
So let's start with a number that completely stopped me in my tracks when I was going through the Q1 data. Let's look at their Safety Clean Sustainability Solutions segment.
The SKSS segment.
Right, SKSS. In the first quarter of 2026, the overall revenue for this segment actually dropped by 7% year over year. But their profitability, specifically their adjusted EBITDA, it actually rose by 17%, up to $33 million. And their profit margins improved by a massive 320 basis points.
Which is a striking divergence, right there.
Yeah, let's translate that financial shorthand for a second for everyone. Adjusted EBITDA is essentially their pure operating profit before things like taxes and accounting depreciation sort of muddy the waters,
Right.
and an improvement of 320 basis points. That means they're keeping an extra 3.2 cents in pure profit on every single dollar they make compared to this exact same time last year. So how do you pull that off while your revenue is actually shrinking?
Well, it comes down to what is essentially an industry-level judo move.
A judo move, I like that.
Yeah, the management team refers to it as their charge for oil pivot, or CFO.
CFO, right.
For decades, the standard in this industry was that a company like Clean Harbors would actually pay auto shops, quick lube places, or industrial sites for their used oil.
Wait, they would pay them?
Yes. They viewed it as purchasing a raw material. They would buy the waste oil, collect it in their trucks, and then run it through their own refineries to manufacture new, clean base oil products.
So they were basically buying liquid trash because it had residual value to them.
Exactly. But over an incredibly painful 18-month period leading up to this quarter, Clean Harbors decided to just flip the script entirely.
Wow.
They forced the market to accept a completely new business model where they actually charged the customer to collect that waste oil.
Oh, wow.
Yeah, they effectively went to the market and said, we're no longer paying you for this hazardous waste. You were going to pay us to safely remove it. And in the first quarter of 2026 alone, they collected 53 million gallons of waste oil under this new paradigm.
Okay, let's unpack this because it's like if a local recycling center used to pay you 5 cents for every aluminum can you brought in, right?
Right.
Then one day they say, actually, we're going to charge you 5 cents to take those cans off your hands. And you still hand over the cans anyway.
Yeah, it sounds crazy when you put it like that.
It does. I have to push back on mechanics of this, though. Why did it actually work? Because if someone suddenly starts charging me for a service that used to be a source of income, my immediate reaction is to find a competitor who will still pay me.
Sure.
Or at least someone who will take it for free. What is the leverage Clean Harbors has that forces an auto shop to accept this?
The leverage is cradle-to-grave environmental liability.
Ah, okay.
A commercial auto shop or a manufacturing plant cannot just pour thousands of gallons of used motor oil down the storm drain. The EPA closely monitors hazardous waste.
Right, obviously.
The producer of that waste is legally responsible for it until it is properly processed. Clean Harbors has this sprawling infrastructure. The massive fleet of specialized trucks, the rail cars, and crucially, the re-refineries capable of actually processing the oil legally.
So there just aren't other options.
There simply aren't enough competitors with that level of scale and, compliance guarantee. If a business wants to stay legally compliant and avoid staggering environmental fines, they are effectively a captive audience.
So they just utilize their logistical moat to dictate the terms.
They did, and they more than doubled their charge for oil rate compared to Q1 of last year.
Doubled it.
Yep. Management was very clear on the earnings call. Having spent that agonizing 18 months changing the industry standard, they have absolutely no intention of giving that pricing power back.
Wow.
However, they are acutely aware of the tightrope they are walking here.
Because at the end of the day, their refineries still need that physical oil to function.
That is the crucial tension in this model, yeah. If they push the collection price too high, regional competitors might suddenly find it profitable enough to swoop in.
Or customers might find alternative, albeit less efficient, disposal methods.
Yes, exactly. Clean Harbors needs tens of millions of gallons of that used oil flowing in every quarter to keep their re-refineries running efficiently. If the physical flow of oil stops, the highly profitable refining machine just grinds to a halt.
So they have to find the sweet spot.
Right. They are constantly adjusting the pricing dial, charging just enough to maximize margin, but keeping it reasonable enough that those 53 million gallons keep flowing into their trucks.
And what's wild is that they pulled this off while the market pricing for their end products, the fresh base oil they manufacture and sell, was actually soft for the majority of the quarter.
Yeah, base oil was down.
It was only late in Q1 that base oil prices started to surge. So they built this resilient profit engine that protects them even when the commodity markets are working against them.
And that late quarter surge in base oil prices is a perfect transition point, actually, because it was heavily driven by the overseas conflict involving Iran.
Right.
The disruption in global energy markets suddenly made oil products much more valuable. But the geopolitical tension that drove up oil prices isn't just a pricing tailwind for them. No, it's actually creating a vast physical traffic jam on the other side of their business.
Okay, which brings us to the industrial services segment. Because on the earnings call, management described this specific segment as flat and operating in a challenged market.
Right.
When you first read that, it feels totally counterintuitive. If global oil prices are up and the energy sector is booming, shouldn't the industrial services side, the guys who service the refineries, be raking it in?
You would naturally assume that, yeah. But you have to look closely at the operational reality of what that segment actually does. A huge portion of industrial services revenue comes from handling what are called turnarounds for major oil refineries.
The turnarounds.
Yeah. A turnaround isn't just a guy with a wrench changing a filter. It is an immense, scheduled maintenance event where a refinery essentially shuts down a major operational unit.
Oh, so they stopped producing fuel entirely.
For that specific unit, yes. They completely shut it down. They bring in hundreds of outside contractors. Clean Harbors sends teams to safely purge the chemical lines, go inside the massive storage tanks, perform ultra-high-pressure water blasting to scrape out decades of built-up crude sludge.
Wow, that sounds intense.
It is, and they handle complex vacuuming of hazardous materials. These are highly lucrative, major capital events for Clean Harbors.
Okay, so why are they flat?
Because of the overseas conflict, global fuel supplies are extremely tight. U.S. refineries are highly incentivized to run their plants at absolute maximum capacity to produce as much diesel and jet fuel as physically possible right now.
Ah, I see.
Every single day a refinery unit is shut down for maintenance, it translates to millions of dollars in lost profit for the refinery operators.
So they don't want to shut down.
Exactly. Instead of shutting down for these major deep cleaning turnarounds, the refineries are just doing what management called quick pit stops.
It's all about maximizing short-term output.
Yeah, keep the fuel flowing.
Here's where it gets really interesting to me, though. It's like, it's almost like an Uber driver refusing to take their car to the mechanic for a scheduled comprehensive engine overhaul because surge pricing is off the charts this weekend, right?
That's a great analogy.
They're just topping off the oil, maybe checking the tire pressure, and getting right back on the road to keep picking up fares. But here is my question. Won't those cars eventually break down? Like, you cannot defer major industrial maintenance on a complex chemical plant forever, can you?
No, you absolutely cannot. And if we connect this to the bigger picture, that is exactly why management isn't panicked about this flat segment.
Okay.
This turnaround work isn't lost to a competitor. It
Yeah.
is simply deferred.
Mm.
You cannot run a complex, highly pressurized chemical refinery at 100% capacity indefinitely without eventually shutting it down for deep cleaning and structural repair.
Right. The physics of the machinery simply won't allow it.
Exactly. Management fully expects that this deferred maintenance is piling up like water behind a dam, and it will likely create a tidal wave of demand later in the year, bleeding into Q3 and Q4.
That makes a lot of sense. But wait, there is another fascinating angle to this geopolitical ripple effect.
Sure.
The conflict driving up fuel prices means diesel is more expensive.
Right.
Clean Harbors operates this staggering fleet of heavy vacuum trucks and transport vehicles. If diesel prices spike, shouldn't their internal transportation costs completely eat their profit margins alive?
You'd think so, but if you've ever wondered how sophisticated logistics companies insulate themselves from inflation, this is the blueprint right here.
Okay, how they do it?
Clean Harbors uses a dynamic monthly recovery fee that is passed directly to the customer.
The monthly recovery fee.
Yeah, it's an automatic surcharge intricately tied to the underlying price of diesel fuel. It's often indexed to the Department of Energy's national averages, and it gets reset every single month.
Oh, wow.
So as the overseas conflict drives up the cost to fill their trucks, Clean Harbors simply passes that exact cost through on their invoices.
So they don't eat the cost at all.
Almost zero negative effect on their profitability because the mechanism is baked into their contracts and it's fully accepted by the industry.
They catch the upside of the geopolitical conflict through higher base oil prices, and they completely insulate themselves from the downside of higher diesel costs.
Pretty much.
It is brilliant. But, while the industrial side is sitting there sort of waiting for these massive refineries to finally cool down so they can get to work, the environmental services segment, or ES, is experiencing unprecedented volume growth.
Oh, massive growth.
And the catalyst isn't macro geopolitics. It is microscopic.
We are talking about PFAS.
The forever chemicals. Let's look at the momentum in the ES segment. Q1 revenue was up 4%. Landfill volumes skyrocketed by 34% compared to a year ago.
That's a huge jump.
And this is the specific segment that just logged its 16th consecutive quarter of margin improvement. They even highlighted one single emergency response field event that generated $10 million in revenue just by itself.
Yeah, and PFAS is the primary catalyst, driving a huge portion of this forward-looking momentum.
Let's define that for the listener.
Sure. PFAS stands for per- and polyfluoroalkyl substances. The reason they are casually called forever chemicals is because the carbon-fluorine bonds inside them are some of the strongest in all of organic chemistry.
Meaning they don't break down easily.
They simply do not break down naturally in the environment. They've been used for decades in everything from specialized firefighting foam to non-stick pans in your kitchen, water-resistant clothing.
Everywhere, basically.
Everywhere. And now they are at the very center of a sweeping global regulatory crackdown.
So what does this all mean? How does that crackdown translate into revenue for Clean Harbors?
Well, recent guidance from both the Environmental Protection Agency and the Department of Defense officially endorsed specific, highly controlled methods for handling and destroying these chemicals.
And what were the endorsed methods?
High temperature, permitted incineration, and heavily engineered lined landfilling.
Okay.
In response, Clean Harbors didn't just wait for the phone to ring. They released a highly specific, concentration-based framework to handle PFAS. They essentially published the definitive instruction manual for how corporations and the government can legally get this liability off their books.
It's incredible irony when you think about it. If you ask the average person on the street, they think of incinerators and landfills as old-school, dirty, mid-20th century industrial relics.
Right, totally.
But in this context, they are literally the cutting-edge, government-endorsed solution to a modern, high-tech chemical crisis. How does their new Kimball incinerator fit into this equation? Because they spent a lot of time highlighting it on the call.
The Kimball facility is a sprawling new high-temperature incinerator they brought online, and it represents a massive capital investment for them. In Q1, it was running at about 80% utilization.
80%?
Yeah, and management noted that was exactly where they expected it to be, factoring in some planned maintenance and early year weather disruptions. But here's the thing, even running at just 80% capacity, that single facility is projected to add $20 to $25 million in pure EBITDA this year alone.
Just from burning hazardous waste at extreme temperatures.
Yes. And when you look at the PFAS market specifically, the growth numbers are just staggering. In 2025, Clean Harbors generated over $120 million in PFAS-related revenue.
Wow.
But more importantly, management noted that their pipeline for upcoming PFAS work is currently accelerating at a 25 to 35% growth rate.
35% growth. I mean, that is the kind of metric you expect from an aggressive software startup, not a waste disposal company.
But the growth is driven by sheer, unavoidable necessity. I mean, think about the scale of the problem here. The military has to completely flush and change out the firefighting foam systems on thousands of specialized fire trucks and across entire air bases.
Right.
Commercial airports have to physically dig up and remediate thousands of tons of contaminated soil before they can even think about building new runways. Municipalities are being forced to install complex filtration systems for their drinking water, which generates concentrated PFAS waste.
And Clean Harbors is the one cleaning it up.
Clean Harbors is positioning itself as the only true end-to-end commercially scalable solution for this.
Explain the end-to-end part a little more.
So if an Air Force base calls them to remediate a site, Clean Harbors doesn't just act as a broker. They bring their own vacuum trucks, they safely package the contaminated foam, they transport it on their own dedicated rail network, and they ultimately destroy it in their own permitted incinerator.
Oh, I see.
No other company has that complete, unbroken chain of custody, which is exactly what highly regulated clients demand.
Okay, this brings me to a concept I've really been struggling to wrap my head around. The sheer logistics of this operation.
It's massive.
You have a company managing 53 million gallons of waste oil, running giant kilns, burning forever chemicals, coordinating landfill operations, and dispatching emergency response teams to $10 million toxic highway spills.
Oh, yeah.
It sounds incredibly chaotic. How do they keep this sprawling, physical, dirty machine running smoothly enough to confidently raise their 2026 profit guidance by $40 million?
It's a great question.
Oh, and by the way, while orchestrating all of this, they hit an all-time company best safety record in Q1, a total recordable incident rate, or TRR, of just 0.39.
Yeah, that safety metric is actually a perfect window into how they operate. To put a 0.39 TIR in perspective, the industry average in heavy waste management and industrial trucking often hovers around 3.0 or higher.
Wow, so they're way below average.
Way below. That means Clean Harbors is operating at roughly 1/10 the typical risk level of their peers.
That's incredible.
And the way they achieve that safety and that operational efficiency comes down to the fact that they aren't just a waste company. At its core, Clean Harbors is a tech-enabled logistics network.
Okay, I have to throw a flag on the play here.
Go for it.
Every single company on Earth mentions AI and tech-enabled on their earnings calls right now just to try and boost their stock price.
Oh, definitely.
It's like, we're an AI-driven sandwich shop. How does an algorithm actually help with a literal toxic chemical spill on a muddy highway?
It's a very fair pushback. But what's fascinating here is the AI we are talking about isn't some generic chatbot writing marketing emails. It is a deeply integrated predictive optimization engine.
All right.
Clean Harbors has actually been using robotic process automation since 2017, long before the recent generative AI hype cycle.
Yeah.
Today, they are deploying machine learning for incredibly complex, highly specific physical tasks. For example, they use it for advanced waste classification.
How does that work in practice, like on the ground?
So imagine a driver picking up a drum of chemical waste with a faded, grease-stained manifest label. Instead of relying purely on a human flipping through a binder, their computer vision and machine learning models can instantly analyze the documentation, figure out exactly what chemical concoction is in that drum, and predict chemical compatibilities.
Oh, wow.
The system instantly flags if placing that specific drum next to another type of chemical on the truck could cause an unwanted reaction or an explosion.
That's amazing.
They also use AI for supply chain routing, calculating the exact, safest, and most fuel-efficient path for a truck carrying hazardous materials through a populated city.
So it's crunching millions of variables related to moving hazardous material safely and legally.
Yes, and management was very careful to point out they use a strict human-in-the-loop approach.
Right, humans are still involved.
The artificial intelligence handles the massive data optimization and document scanning. But highly trained human experts always verify the safety and compliance before a truck rolls. But the real revenue magic of their technology and how it enables their network density is the cross-sell machine.
The cross-sell machine, walk me through how that functions.
Okay, so Clean Harbors currently operates about 60 different lines of business. They're aggressively expanding their physical footprint, opening 18 new field branches in 2025 and planning 10 more for 2026, essentially blanketing the North American continent.
Okay.
Now, imagine a manufacturing plant calls them for a routine technical service, maybe just picking up a few pallets of standard chemical
A
waste.
basic, everyday transaction.
Right. But their data systems and integrated sales teams know that if you generate this specific type of chemical waste, you probably also have massive underground storage tanks that legally require annual cleaning. The predictive model suggests you likely have a fleet of transport trucks that might occasionally suffer an oil spill. So when the Clean Harbors truck rolls up to grab those initial drums, the system has already prompted the account manager with a highly targeted cross-sell.
Sneaky.
Very smart. While they are on site, they seamlessly pitch dispatching a specialized vacuum truck for those tanks, and they sign the plant to an emergency response retainer for their fleet.
Wow. It creates this dense, highly profitable web of services. They
Yeah.
aren't just selling a one-off disposal. They are systematically becoming the inescapable first call for absolutely any environmental need a company might have.
Exactly.
You start by having them take away your used motor oil, and suddenly they are managing your entire hazardous footprint.
And because their trucks are already in the area, the marginal cost to provide that second or third service is incredibly low, which is exactly why those profit margins keep expanding quarter after quarter.
Well, let's pull all of these threads together. Our mission today for this deep dive was to understand how Clean Harbors is generating such incredible momentum in a seemingly unglamorous sector.
Right.
And looking at the Q1 2026 data, the picture is incredibly clear. They achieved total revenue of $1.46 billion and expanded their pure operating profit to $247.9 million.
Huge numbers.
They are dominating by fundamentally changing the rules of oil pricing with their charge for oil flip. They are absorbing current geopolitical shocks, simply waiting to ride the inevitable wave of deferred refinery maintenance. They are perfectly positioned to capture the exploding PFAS regulatory market with their high-temperature incinerators. And they are tying this entire sprawling, highly physical operation together with AI-driven logistics and a relentless cross-selling strategy.
And it's that convergence of strategies that allowed them to confidently raise their full year 2026 adjusted EBITDA guidance by $40 million, bringing midpoint to an astonishing $1.27 billion.
Wow.
I think the biggest takeaway here for you listening is that this case study completely shatters the prevailing illusion that true innovation, structural advantages, and technological leverage are restricted strictly to software companies.
Yeah, the physical world still matters.
More than ever, there is immense, undeniable value in mastering the unglamorous, highly regulated, complex realities of the physical world. Clean Harbors is proving that if you can efficiently and safely clean up the mess that modern industry leaves behind, you can build an absolute fortress of a business with an incredibly wide moat.
It really is a phenomenal story of operational leverage and grit. So I want to leave you with a final question to ponder as you go about your day.
Let's hear it.
We've just seen how a company dealing with hazardous waste, toxic sludge, and dirty used motor oil can forcefully flip their industry's entrenched pricing model and use machine learning to build an unstoppable, margin-expanding profit engine. If they can do that with garbage, what overlooked, unglamorous, entirely physical processes in your own industry might be hiding a massive, untapped opportunity just waiting for a structural flip?
It really makes you look at the dirty, everyday jobs in a whole new light. The opportunity is usually where people are afraid to get their hands dirty.
It really does. Thank you for joining us on this deep dive into the hidden machinery of the economy. We will catch you next time.